we've had a shortage of supply for the last 6 years or so. Meanwhile, industrial demand has continued to grow and grow and grow. I mean, the shortfall over the last 6 years works out at just a little less than one. I think it's sort of, I can't remember the figure, but I mean, it's enormous. I think we're looking at 1,200 million ounces. I mean, it is enormous. So I think the first question you have to ask yourself is, how have they managed to suppress the price of silver? And to me, the answer is actually quite simple, and that is that China has been managing the price.
Gold and silver may be on the edge of a historic repricing, one that could echo the great monetary ruptures of the past. In a startling assessment, precious metals specialist Alasdair Macleod warns that the next surge in gold could mirror the chaos of earlier fiat failures, where currencies collapsed while gold soared to levels previously unimaginable. Silver, long suppressed by years of structural shortages, may experience an even more dramatic acceleration as industrial demand collides with tightening global supply. The question he raises is not how high precious metals will rise, but how rapidly the purchasing power of modern currencies will fall. For more than 6 years, silver has faced persistent supply shortfalls, amounting to nearly 1.2 billion ounces. Despite this chronic deficit, prices have remained far below levels justified by fundamentals. Macleod argues that China played a central role in keeping silver prices contained, using its influence over exports and refining to stabilize global pricing. But the landscape changed dramatically as geopolitical pressures intensified, particularly during the period following President Trump's election, when tariff threats disrupted China's ability to quietly manage commodity flows. That shift, he suggests, began to expose the underlying imbalance between silver's soaring industrial demand and increasingly fragile supply streams. The stress within market infrastructure has begun to show. A recent failure in the COMEX database, officially attributed to a cooling fan malfunction, raised suspicions among market observers. With multiple redundant backup systems that should prevent precisely this kind of outage, many questioned whether deeper systemic strains were emerging. Whether coincidence or warning, the event highlighted how vulnerable the futures system may be if pressures in physical markets continue to build. If you're finding this analysis helpful, don't forget to like this video, subscribe to my channel, and hit the bell icon so you never miss future updates on gold, silver, and global market trends.
But things have changed. And the big change, I think, was at the time when President Trump was elected back in November last year into April, when, do you remember, he held up those boards with all the new tariff rates and all the rest of it? China, I think from memory, is something like 50%, whatever. I think that ahead of that, the Chinese could see that the price of silver, demand for silver was running away, and they couldn't really control it anymore. And not only that, but with President Trump threatening sort of huge rate tariffs and really, being very unpredictable in the whole thing. I mean, he would say one thing one day and another thing the next day. It really meant that China had to take a different view on its exports of things like silver, tungsten, and also antimony. I think the previous Friday, a week ago on Friday, that suddenly out of the blue, we had this COMEX failure. I mean, it wasn't a COMEX failure, it was a database failure because the cooling fan stopped working. So, we can't say that was we can't sort of act as conspiracy, with a conspiracy theory on this one. But, this sort of thing doesn't happen because you've got backup systems which automatically kick in when a cooling system fails. And I was reading somewhere that someone who, was an electrical engineer who deals in these things and all the rest of it, reckoned that, important databases like that are not protected not only by one backup system, but 2 backup systems. So how did all 3 fail at exactly the same time? Big question.
Seems a bit suspicious.
Yeah, so I mean, but the point is that these markets are already facing huge strain as those distortions which are built up over the last 54 years are beginning to be unwound.
Yeah, but
this is just the start. So where does silver go? I mean, the problem with photovoltaic cells and electric vehicles and all the rest of it is that demand is unlikely to change much on a big price hike. Because this is all driven by government diktat. We must get rid of the carbon footprint, all this sort of stuff. That's not going to change very quickly. It really is not. I don't know how. I mean, you can get a squeeze in these markets, which would just take prices to unrealistic levels. Whether that'll happen. But I tell you one thing, this is turning into, what we would call a Giffen good. In other words, the normal laws of the relationship between supply, demand, and price are just completely suspended. That's something that the market decides. And if you've screwed the market and the market kicks back, all bets are off. I mean, it really is. I think it also, Paul, in the broader context, what we are seeing are things happening at the end of the fiat currency system. The fiat currency system is coming to an end. And that has enormous implications for everything. If you look at bond yields in Germany, not too far away from you, rising into new high ground. And you look at Japan, the 10-year is nearly yielding 2% now, which is just absolutely unbelievable. The point about both the euro and more particularly the yen is that these are the basis of the carry trade on which US Treasury financing has been increasingly depending. Now, if you've got rising yields in Japan in particular, the first thing that happens is that one of the largest groups of holders of US Treasuries, Japanese institutions, will no longer be buying US Treasuries because they're getting almost the same sort of yield out of their own markets without the currency risk. And on top of that, of course, the carry trade has problems. There's a huge, great carry trade has come out of the Cayman Islands, which basically is offshore hedge funds and insurance companies, offshore insurance, captive insurance companies. They've been funding their US Treasury yield pickup out of Japan in particular. And then if you look at Luxembourg, American entities have been setting up special purpose vehicles to offer higher returns to EU residents than they get out of their own bond markets. And where does that go? That goes into the US Treasury, T-bills and things like that. That is now going to get constrained. So what happens to the yields? They rise.
Yeah.
And when they rise, what happens to the equity bubble? Pop. And then suddenly you've got a real crisis.
Silver's industrial role makes its demand uniquely insensitive to price spikes. Photovoltaics, electric vehicles, and various green energy technologies all rely heavily on silver, creating a government-driven baseline of consumption that will not decline even in a rapid price surge. This dynamic risks creating a market where traditional supply-demand rules do not apply, what economists call a Giffen good, where higher prices fuel further demand and destabilization. Against this backdrop, Macleod points to a broader and more alarming trend: the weakening foundations of the global fiat system. The world's major bond markets, the Eurozone and Japan in particular, are experiencing rising yields after decades of artificially low rates. As Japanese yields approach levels unseen in generations, the incentive for domestic institutions to continue buying U.S. Treasuries diminishes sharply. The massive carry trade, once fueled by cheap yen funding, begins to unwind. Luxembourg-based special-purpose vehicles, long used for channeling European capital into U.S. debt, face similar constraints. In this environment, U.S. Treasury financing grows increasingly dependent on short-term T-bills and money market funds, a structure that becomes dangerously fragile when liquidity tightens. To maintain system stability, the Federal Reserve has been forced to halt quantitative tightening and move back toward balance sheet expansion. Rising inflationary pressures now collide with the need for lower interest rates to support an overstretched financial system. Let's get back to the video.
And of course, the US Treasury is having to rely increasingly on funding, short-term funding through T-bills. It's been tapping money market funds, for example, almost acting in parallel with the Fed as, if you like, a sort of secondary central bank. This is a very unusual situation. Now, not only that, but you can see that because the US Treasury has been hoovering up liquidity, and at the same time the Fed was doing quantitative tightening, it's now had to stop doing QT, and it's going to resume QE in order to ensure there's sufficient liquidity within the financial system to stop it falling over. So, we can see the drivers of inflation beginning to really get going again in America, one way and another. And this is something which I don't think anyone's talking about. But you can see that if we get inflation coming back, when the Fed is trying to reduce interest rates and a bubble is popping, when that bubble pops, they're going to have to basically, print in order to save the banking system, save also all the zombie corporations, try and stop unemployment rising, et cetera, et cetera. So, you can see the acceleration of the increase of base money, if you like, and it's going to be very serious. It's actually very similar to where the Reichsmark, the Reichsbank, was in the second half of 1921. I've been looking at these figures really because it's when you get the end of a fiat currency system, that is the best example, the best documented example we have of what actually happens. And it's interesting because we had a roaring stock market in Germany between January, February 1920 into the tail end of 1921, when stock prices on average increased by 300%. The currency stabilized, incidentally, and was briefly the best performing currency of the lot. This was the Reichsmark. This was after losing about 90% of its purchasing power, from 1913. So you had that sort of pause. But in the second half of 1921, the gold price started rising, measured in Reichsmarks. We use the dollar as proxy for that because, the dollar was on 20.67 and it was firmly there the whole way through this episode. So as far as, the sort of, if you like, the commonality of what happened then compared with now, we got the tail end of this stock bubble. That goes pop. In the case of Germany in 1921, December the 1st marked the crash, if you like. But the crash was softened. It only fell 25% on estimates. But if you looked at the value of stocks in gold, they lost 93%. That was the difference. Because at that stage, the purchasing power of the Reichsmark was really beginning to collapse. If you got the end of the fiat currency system, then measured in fiat currencies, gold is, well, I quoted Reichsmarks. An ounce of gold in Reichsmarks went from 90 in 1913, when the gold Reichsmark was suspended, to around about 100 trillion per ounce of gold in November 23. What more do you need to know? Yeah. I refuse to give predictions on the price of gold because it's not the price of gold that matters. Actually, what happens is the purchasing power of the currencies you measure it in. Those are going down. It's not so much gold going up, it's those going down.
What appears to be rising gold prices are, in reality, falling currency values. In the Weimar period, gold moved from 90 marks per ounce to nearly 100 trillion in just over a decade, not because gold changed, but because the currency disintegrated. If global fiat currencies are approaching a comparable endpoint, precious metals may soon reflect that reality with unprecedented speed. These developments raise profound questions for investors navigating a world where debt burdens, monetary expansion, and geopolitical shifts converge. The transition away from the dollar-centric system, already visible in China's evolving gold-linked trade mechanisms, may accelerate as confidence in fiat stability erodes. Whether the global monetary system can adjust gradually, or whether it is heading toward a sudden break, remains the defining question for the years ahead. As pressures mount across commodities, bond markets, and currencies, the long-suppressed forces driving gold and silver may be preparing to assert themselves fully. The strains emerging from persistent supply shortages, rising geopolitical uncertainty, and the weakening credibility of major fiat currencies are converging to push precious metals into a new phase of price discovery. The possibility that precious metals could undergo a dramatic revaluation is no longer theoretical but structural, shaped by deep imbalances that are now too large and too visible to be contained by conventional financial tools. If you found this breakdown helpful, don't forget to like, subscribe, and share it with others following the gold market. Thanks for watching. Stay informed, stay balanced, and I'll see you in the next video.